I thought one and done this year, a token increase. There's no fundamental reason for them to raise rates. Growth is actually, the first quarter is probably going to be sub 1%. We see inflation declining. If you look at wage growth, participation rate's abysmal, as we all know. The job creation has only come in two segments of the population, age 54 and older, and the part-time worker. And then 50% of job creation since '09 came from two states, North Dakota and Texas.
Well, I don't think the economy is that fragile. First of all, we should not overreact to one miss on an employment report. This is an estimate of the seasonally adjusted change in a magnitude of 140 million people. You know, to miss by over 100,000, that does happen from time to time. But I think you've got to look at all the other things. Look at ADP, look at the services, ISM services employment component, look at unemployment claims. Overall, we were never really growing, I think, at 300,000 jobs per month. But I think we're not growing at 126,000 either. It's a bit better than that. And as for the economy tolerating Fed rate hikes, I absolutely think the economy can tolerate Fed rate hikes. It's just got a lower trend growth rate, much closer to 2 to 2.5% than the 3% we've been used to. But it is still about time for the Fed to get raising rates. And we still think they will probably do that by September.
I mean, I definitely think we're going to see a recovery in the back half of this year. I mean, certainly going into 2016, we're very, very positive. I think that we've kind of dodged a bullet on Iran. I was expecting more of a sell-off because people would get way ahead of themselves, believing those Iranian barrels are coming back. I think people are being sensible now, realizing it's not an event till 2016. But I do think there are a lot of things that could take us either way in the market. You've got the Middle East map up there. I mean, we're so close to something happening in the Middle East that could move us significantly higher. It's just a question of timing.
How in the world do you trade it then?
Well, certainly, I think if you're just looking at when should CapEx cuts filter through and we should see the demand pick up, you're safe with the back half of this year, certainly Q1 2016. But then you have to think about event risks. When Saudi sends 150,000 troops to the border with Yemen, and they usually don't send their troops anywhere, you have to be worried about Middle East premium somehow kicking back in.
I think right now what we're seeing is a little bit of after effect from the big move started in 2011 and 12. We saw that huge gold sell-off. And then enter 2014, we start to see the dollar pick up and Fed tapering end. And now all of a sudden, gold looks like it's going to continue to skid down. Over the last 3 months, we've sort of hit a couple of bottoms here between the 1130 and 1140 mark. And now we're starting to see it go back up. If the Fed intends to raise rates, the dollar should remain strong, and yielding instruments in the U.S. should continue to be more attractive than gold. I don't think that's the case here, and I think the Fed is only one piece of the puzzle when it comes to gold pricing. And if you look at the volatility of gold, which is very low, prices which have bounced off a recent double bottom, I think gold is a big buy here with all that you don't know about what the Fed's doing, what you don't know about what's going on in the Middle East. And as a buy and hold instrument, I think it still has a lot of value.